When people talk about financial inclusion, they often mean apps or APIs or digital wallets. They might mean smartphones to bank the unbanked, or crypto to be your own bank, or a digital platform for democratizing finance. But here in Edinburgh, the story of financial innovation and financial inclusion go back way before the era of smartphones and even before computers.
Across Britain in the 18th and 19th centuries, reformers invented new ways to pool money and risk. Savings banks, building societies, insurance mutuals. The very first building societies and some early life offices are English, rooted in Birmingham and London. Scotland enters the story slightly later, but takes these ideas in a different direction. That's because, well, Scotland is different. It has a small urbanized core without a huge landed elite, and there aren't that many aristocrats or big city merchants. To grow, Scottish institutions have to be more useful to ministers and teachers, clerks and artisans, the working and professional classes. Of course, so did banks in England, and Scotland had its share of large-scale enterprises, but the balance was such that Scotland's banks and insurers tilted towards the common person. But this immediately creates a problem. It's an age-old challenge. Serving smaller accounts is, per unit, more costly. Finance and money prefer to serve the rich and the big. Scottish institutions could only scale by what today we'd call fintech. And back then, it was called mechanization. By the late 19th century, in Britain, there are three pillars of mass market finance in place. First, savings banks, institutions that take pennies and shillings from workers, not just lump sums from merchants. Second, building societies, clubs that turn rent into mortgages and home ownership. And third, mutual life insurance, funds designed so that if a breadwinner dies, their family isn't immediately thrown into destitution. In Scotland, each of these forms is deliberately framed around non-elite households. Savings banks run school accounts. Building societies in Edinburgh and Glasgow pitch themselves as friendly ways for clerks and artisans to acquire property. They're not speculative punts. And life offices talk openly about protecting widows, orphans, and the artisan classes.
By the early 20th century, Edinburgh had in place both the ideology and the institutions to enable financial inclusion. The institutions including the building societies and the insurance companies, whose business model was to accept small, regular contributions from ordinary people to provide them services. What it lacked was the muscle power for all the processing that was required to scale this up. Enter the machines.
In the early 1900s, banking is still a pen and ink business, and they call the teams who sit in long rows, copying entries by hand into heavy ledgers, penmen. Their speed and accuracy limit how many customers a bank or a mutual can serve. Mechanized accounting begins to change that in the late 1920s. Adding machines like this Burroughs model can rattle through long columns of pre-decimal figures. And by the 1940s, banks have rolled thousands of machines across their branch networks. The result is the unit cost of keeping an account collapses. It suddenly becomes commercially viable to maintain tens of thousands of tiny savings balances, mortgage installments, and weekly insurance premiums. But the explosion in business keeps the accountants in their seats doing other work. This allowed Scottish banks and building societies to turn an English experiment in mortgages into a mass industry. Industrial life policies go from the manager's office to the factory floor and the docks, where agents collect small weekly premiums from working-class households, people who could never build a large savings buffer on their own. But at the same time, these institutions could never build a business handling tiny amounts of thousands of policyholders every week if it was all done by hand. And so it was the addition of the adding machines and later punch cards that allowed these flows to become, well, processable, but also data. And This allowed ideas about mutualism to scale. Mechanization doesn't just change what work is done, it changes who does it. Typewriter machines begin to proliferate in bank branches in the early 1900s, and banks begin to hire women to operate them. This is accelerated during the First World War. As men leave for military service, lady clerks step into roles that were previously male preserves. Now, customers' reactions range from amused to hostile, complaints about silly, giggling girls at the counter, but the structural change is irreversible. Women become central to the machinery of finance. And over time, that presence moves into the customer base. The same institutions that once insisted on a husband's signature begin to produce booklets like Why a Woman Needs a Banking Account, teaching women how to manage money in their own names. By the 1950s, the volume of data generated by this new mass customer base is overwhelming. Savings deposits, mortgage installments, insurance premiums, check payments, all of it has to be recorded, reconciled, and reported. In the late 1950s, a few banks installed the first banking computers, enabling branches to send transactions on punch cards and later on punched tape over telephone lines. Physical ledgers give way to bookless bookkeeping. Once you can run all those small, regular payments through a central computer, you can offer consistent services in dozens and then hundreds of locations. By the early 1970s, the back office foundations are in place: national networks, online cores, real-time balances. The logical next step is to put that capability in customers' hands. Just as our generation has the smartphone, the British retail public got the ATM. The most important was Cashpoint, a brand introduced by Lloyd's in 1972. Now, this is a branded network of online real-time cash machines that let customers withdraw debits from their accounts instantly and let banks update their balances on a mainframe computer. It's the M-Pesa or the WeChat Pay of the last century.
Financial innovation isn't new. It's always been about ways to access your own money. Of course, these days, my smartphone has a lot more data and information and transaction processing than this old thing. But the concept of including people is not something that just started out of Silicon Valley. In fact, if we can pinpoint the epicenter, the ground zero for financial inclusion, it's probably here in Edinburgh, where for decades, if not centuries, people have been adapting fintech that was originally designed for big companies and rich people to meet the needs of everyday people.